Board of Directors. VCs will generally own less than 50% of the companies they invest in and won't be present at their portfolio companies on a daily basis. As a result, they'll want some language in the term sheet that grants them some control over actions that could have a material effect on their investment in the company. The entrepreneurs also need to spell out specific actions that will have an effect on the direction of the company and need to hold VCs accountable. This is where the concept of control comes into play. There are 4 major control provisions in the term sheet. The first is the Board of Directors. This section is located in the voting rights section of the NVCA term sheet. The Board of Directors is the top of the management food chain and is the most powerful entity in a company. The board is responsible for approving corporate strategy, mergers and IPOs, budgets, executive compensation packages, and monitoring the success of executives. The board usually has the right to fire the CEO. The board also has a fiduciary duty to the company, meaning the elected members have to act in the best interest of the shareholders and are not allowed to put their interests before the interests of the company. A board of directors for an early-stage company usually consists of 3 or 5 members. An odd number is best for breaking any ties in decision-making. Representation on the board is typically held by the company, the investors, and outside board members, not employed by the company who have insight in the industry that the company is in. When negotiating this clause, it is important that the entrepreneurs strike the right balance between company, investor, and outside board members. Let's read the Board of Directors clause and break it down. It reads, "At the initial closing, the board shall consist of blank members, comprised of 1. Name, as the representative designated by blank, as the lead investor. 2. Name, as the representative designated by the remaining investors. 3. Name as the representative designated by the founders. 4. The person then serving as the chief executive officer of the company. And 5. Blank person or persons who are not employed by the company and who are mutually acceptable to the founders and investors, to the other directors." This clause paints the picture of a 5-person board, but as stated previously, 3-member boards are also possible in early stages of the company. Boards can also consist of 7, 9, or more members in larger companies. The concept of this clause is that there will be equal representation among the company and investors, with the voice of the outside board member to bring an external opinion and possibly break any ties. Let's look at the case of a 5-member board, as stated in this clause. The member holding the first seat is designated by the lead investor. The lead investor is the investor who, as the name states, led the round, probably invested the most money, and provided the social proof necessary to attract other investors. For their efforts and commitment to the company, they are rewarded with a board seat delegation. The second board seat is delegated by the remaining investors. But what does the term remaining investors mean? This is often the subject of debate. One school of thought mandates that the owners of common and preferred stock vote as one voting class, meaning the class that has the majority of ownership in the company will carry the vote. The second school of thought is mutual consent, meaning all remaining investors need to agree on who will hold the second seat. The third seat is held by a member designated by one of the founders of the company. The seat is usually held by a founder. The fourth seat is held by the CEO of the company. The fifth seat is held by the outside board member. This scenario creates a balance of power between the company and the VCs.